Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Nathan Meyers with the Option Risk Calculator that we've been looking at as a community recently. Quick disclosure before we start, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So I'll stop sharing my screen and pass the ball over to you, Nathan, and you should have it. So welcome.
I'm now the presenter, and are you seeing my screen?
You need to share it, so go onto the Share menu.
Okay. Go onto the Share menu, which is there,
and then
share my screen.
My screen. Yep, okay, see it's starting to load. There it is.
Okay.
So I just want to say thank you for coming on, Nathan. Like I said, we've had a lot of people interested in this option risk calculator. As Dan Harvey gave us a nice overview of how he uses it, and Dan's joined us. So we're excited to have you here, and welcome.
Thank you. Thank you. My name's Nathan Meyers. I am a software developer, been a software developer in the industry for going on 40 years now. And it was such a surprise for me to hear from Tom last week about this. This is a tool that I wrote years ago when I was first starting to learn about options. And I was starting to use a lot of the risk tools out there, the kind that would draw the risk charts that we're all very familiar with in option trading. And as I was using them, I became aware of certain things about them that were frustrating me. Some of it was sort of lack of transparency into what they were doing, and some of it was certain capabilities that I really wanted to see that weren't there. And that led me to do some exploring on my own that ultimately led to the development of the software that you see here. The original thing that really got me developing and exploring was the idea that, of course, we all know what the usual charts look like, but I wanted a different way to view the data, a way that ultimately I came to call the outcome probability chart, which is a way to view the data that lets you get a better understanding of what the outcomes are, what the likelihood of the various outcomes are. And one of the things this calculator does is it presents that view of the data, and I'll be showing you that as I show you the capabilities of the calculator. I originally started my explorations by creating the outcome probability chart in a language called R, the R programming language, which has some really cool analytic tools, and that's where I first started generating those charts. And it was cool and informative, but it was a real pain to set up and use. And so I decided instead to write it as a Java application, with a user interface that would be both a basic option risk calculator where you can see the usual familiar option risk charts that we're all used to, but that would in addition offer a way to compute this outcome probability chart. My original implementation of that was as a Java application using the Swing Java user interface. And made available through what's called Java Web Start. And what that means is that you would go to my website, javalinux.net. You would go to my website, you would click on the page or click on a link on the page, and would actually bring up the application on your system as a Java application. So it would download Java libraries to your system. It would run the Java application locally on your system right from the browser. So a window would come up, you'd be operating the calculator in Java. And it worked really well, but it turns out that there are certain challenges to distributing applications as Java Web Start applications. One of those is that it requires the user to install Java on their system. It has to be a current enough version of Java to be running the application. And another is there are certain controls around how this stuff is distributed. Those controls are put in place for security to keep people like me from distributing software that can do damage to your system. And over time, the Java enforcement of that security became more rigorous, and I began running into problems where people couldn't run my application anymore, or if they brought it up, they were presented with some really scary message that said, this thing could destroy your disk and eat your children. Are you sure you want to run it? And so it became problematic and more problematic over time as these controls were increased to distribute the application this way. So I rewrote it, and I moved it to a different platform. The basic Java logic is still there, but I rewrote the UI to use the Google App Engine. And that's the version of the tool you see today. It's implemented on the Google App Engine. It is running on Google servers. That's what the appspot.com is. And it's running on Google servers and obviously implementing a nice web interface through those servers. And that is the option risk calculator that you've seen and that we're going to take a look at today. To start with, I'm just going to show you like the quick 10-second demo, which is I'm going to take one of these example trades, one of these many example trades that I have in there, populate the input fields with that trade, and generate a risk chart. So you're going to see something that looks very familiar. You've seen other tools that have done this, and it was my work with those other tools that got me started on writing this. You see the usual closing trade price versus stock price. You see a probability curve. This is a log normal distribution that is showing the likelihood of various outcomes. And you see some summary statistics down here that are telling you, the price of the stock when you open the trade, the various parameters that you set up to run this sort of analysis. And a few statistics, the median price, the mean price, and of course some disclaimers at the end that any risk you take are your own. So the inputs to this thing are what you typically find in tools like this: a current stock price, a dividend rate if there are dividends, an initial stock position if this is something like a buy right, for example, where you could set up an initial position. Let me drop in another trade to show you what that would look like. An initial stock position, and it treats this as part of the trade. It treats the purchase or short sale of this as a transaction at the beginning of the trade, and treats it as part of the overall trade. So here's a very familiar looking covered call. And it considers the purchase of that 100 shares of stock part of the initial outlay, and it incorporates that into the profit loss calculation that it's showing you. And as you can see, when I place the cursor on the risk chart, you can see at any particular position what the profit or loss is. You can see what the underlying closing stock price is to get to that, and you can see what the probability is of landing on or above that spot. One cool control we have here that you probably don't see on a lot of these tools is normally these show you the position at the end of the trade, what it's going to look like when the trade ends, when the option expires. But you have the ability with this little slider at the bottom to choose some other interim date, anything between the day after you open the trade up to the closing date. And so on the closing date, of course, the math is really simple here to compute the value of the position. Anytime before the closing date, you are using the Black-Scholes model to figure out what the theoretical value of the option is, basically figuring out what the time value is going to be to come up with this curve. So pretty straightforward stuff, a lot like what you've seen in other tools. I'm going to take a moment just to talk about what you're seeing on this screen before I go on. I take it, Tom, that I'm the only one talking. The mic is not generally open.
Right. We've got the presenters, you, me, Dan, Jim Riggio, and then everybody else is just in listen mode.
Okay, so I shouldn't ask for a question or show of hands or anything like that, probably.
Well, they can put it in the chat.
Right.
If you want to end up taking a survey or ask people for their feedback, they can type it in the chat.
Okay, and I will see that chat somewhere.
Yeah, if you hover, put your mouse up at the top of your screen, you'll see that
there we go.
drop down.
Chat. All right, I'm going to bring that up.
Now, just realize that that chat window is grayed out, so it covers your screen, and we can't see behind it.
Yeah, so
you
if you
can't
have
see behind it, but
right.
If you have another
it's just
monitor,
covering
it's
an ad.
better.
It's covering an ad right now. So,
that's good.
Yeah.
So you should be fine. Okay, so I'm going to open that chat window because as I talk about what's on the screen, I'm going to take a moment to talk about what's on this screen before we move on to showing other features of the tool. As you see, obviously we have the familiar looking price curves shown at the end of the trade, and we have a log normal distribution here, a bell-shaped curve. If the x-axis were logarithmic instead of linear, this would actually look like a normal distribution, but as you can see, it's a little wider to the right. It's a log normal distribution. And this probability chart is obviously very important because this is what you use to ascertain the probability of success in the trade. I've already gotten a first question, and I'm actually going to be answering. I think, Rakesh, that you're going to hear an answer to my question in just a minute. So let me ask a question that I'm going to throw out to the chat, which is, looking at this probability curve, what determines the width of this curve? What determines the fact that our 1 sigma line is out here a little below 45 and our minus 1 sigma and our plus 1 sigma line is out here at about 56? Volatility, right? Volatility and, of course, the passage of time. Now, harder question, the topmost point, the 0 sigma line in the graph, what does that represent? Okay, no one's jumping in on that. Mode, it is not the mode. The mode is the most occurrences, but it's not, I guess, supposedly it could be the mode. What it actually is the median. It's the middle value. Half of the outcomes are to the left, half of the outcomes are to the right. It's not the mean. The mean is going to be a little bit to the right in a log normal distribution, but it's the median. Okay. Next question, what determines where this lands? You'll notice that our starting stock price was 50, and this landed for this particular calculation. The median price landed just a little bit short of 50 at 49.84. What determines where this is centered? In other words, where the whole curve lives, and therefore, of course, the probability of success. Skew. Good. Of course, there are actually 3 things that go into determining where it lands. The first thing is your starting price. Obviously, it's going to end up somewhere based on the starting price. The second thing that's going to determine its location is the skew, the assumption. Now, I assume you're interpreting the skew the way I think, which is the assumption of growth in the underlying stock price. You're always making an assumption about the growth in the underlying stock price. And the third thing, believe it or not, that helps determine where this median lands is the volatility. When you set up a test like this, when you set up a calculation like this, what you're doing is you're making an assumption about growth in the underlying stock. And when you talk about these random returns, these normally distributed random returns, you're talking about a random walk that is not made around the starting stock price, but rather a random walk around a growth curve that is assumed for the starting stock price. So going back and looking at our original, going back and looking at how we set up the problem, what are we assuming for the growth rate of the stock price? Well, what are we assuming for the skew? And I will tell you that that number is hiding in plain sight on the inputs here. Exactly. The risk-free rate. what we're specifying here is the risk-free interest rate is actually doing double duty. It is being used in the places where we need to do the Black-Scholes calculation. The risk-free interest rate is being used in the Black-Scholes calculation, which is actually not used to generate any of these results here. And the other place we're using it is we are using it as a skew to the stock price. We're using it as an assumed growth rate. So if I, say, set this to a larger number, like 10% growth, we're going to see that the mean has now moved to the right, or excuse me, the median has now moved to the right. And so we have landed at a median value of $51.20. So this risk-free rate is doing double duty. It's used for Black-Scholes. It's also used to place the probability distribution. And one of the things that bugged me about a lot of these tools when I was getting familiar with them and starting to work on my own tool is that wasn't at all transparent to me. It wasn't obvious to me that the risk-free rate being used for the Black-Scholes calculation should also be the assumed growth rate of the stock. I may be setting up a trade where I'm making assumptions that are different from that. So right now money is cheap. The risk-free rate is 1%. That's starting to go up a little bit, but for now we'll say it's 1%. But I may want to make a trade on the assumption that this stock is going down the toilet and is going to grow at minus 10%. So what I've done with this calculator is given you the option to set up a different stock growth rate from the risk-free rate. So that 1% will still be used where it's needed for option pricing model, but a different value will be used for the projected stock growth rate. So now you can see our curve has moved to the left, and the median is now in the 40s. The median came out to $48.06. So you have that option, and as you can see here where we're reporting the results in the descriptive text, we have pointed out that the assumed annualized growth rate is different from the risk-free rate. The other thing that affects the placement of that curve, so let's see if we're going to get this out of here, so go back to our usual 1% implied growth rate. The other thing that affects the placement of the curve is the volatility. It turns out that as you increase the volatility, it causes the median to move to the left. And let me show you an example by setting a very low volatility right. And now you will see that our median has moved. Of course, you'll see that our curve is now a lot narrower. It's covering a much smaller price range. And you'll see that the median has moved up to $50.15. Before it was a little bit below $50. So to make this stand out a little bit more, I'm going to set our expiry out to a year away. What's today? Today is June 28th, so let's set it to June 28th, which I realize isn't the third Friday, but it's just math. So now we're looking at the projected outcome a year out with an annualized growth rate of 1%. In fact, to make it more obvious, I'm going to set this rate to 10%. And we're going to see that here, the median is now at 55. And if we go back to a higher volatility, the median is now a little bit less. Okay. What did I set that to? 10%. Back to the 20% we started with. The median is now less. It's now around 53 or 54. So those three things together, the starting stock price, the growth rate, the skew, I should say, and the volatility help determine where that median is going to end up. And obviously that has a lot to do with your decision about the risk of the trade and the profitability. So moving forward with the capabilities of this tool, I'll show you a couple of cool capabilities before I go into the simulation stuff. One is you're doing this simulation, you've got something interesting, you want to share it. You have the ability to generate a couple of URLs that are very useful for sharing the trade. One I call the non-interactive URL. You can send this to a friend, they can launch it, and what they're going to see is a page that shows you just this graph with the same animation, with the same information available as you move along the price curve. And you have another URL you can generate, the interactive URL. You send that to someone, and it's going to throw you into the same place that you're in. That is, it's going to set up the trade, and it's going to bring up the trade risk chart, and they can play with it the same way that you can. So, back to our risk chart now. The simulation, and it's easy to read a lot into what I'm supplying with a simulation, but the purpose of the simulation here is to come up with a different way to present the same data you're seeing here. So I'm going to go back to the trade I started out with and a long call in the money. That's a nice, easy curve to understand. And I'm going to run the trade outcome simulation. And what this is going to do is show me basically the same information that we're seeing in the first chart, only rather than showing it as price versus stock price, rather than showing it as trade value versus stock price, and you're having to, say, compute the differences between position on the probability curve, this actually has it laid out as profit loss versus the versus percentile, versus chance of reaching that profit loss. So for example, on this chart, we're able to go to the break-even point here and see that, let's see, our break-even point is at about 44.9%. And if we look at the outcome, the trade outcome simulation, we're going to get the same information. We're going to see that the break-even point is, the break-even point is up here at about 44.2%. That's our probability of coming out above the break-even point. So you're getting the same information here that you're getting here, but in a way that I hope makes it easier to evaluate the probability of the trade. So the intent here is not to provide a full simulation of a trade, and particularly a trade with interesting complexities. It's a matter of providing an alternate view of this data that is more easy to interpret, and it turns out that while it's hard to come up with an analytic expression to do that, the easiest way to solve that problem is just to simulate. It's just to run a Monte Carlo simulation, generate a bunch of prices, generate a bunch of outcomes, and in that way come up with this curve. So that's the purpose of the Monte Carlo capabilities in here, is to generate this curve. If we look at, let's pick a more complicated trade, like let's pick a long straddle. Now this one's a little harder to understand because, of course, the most successful parts are in the tails here. And so looking at this and understanding the probability of success gets harder, and this is, again, where the simulation tries to make it easier. This view of the trade again, it's showing the same information here, but by laying it out as profit loss versus probability of success, you can understand what's in the tails, you can understand what's in the middle by looking at this probability of the outcome. So question, how many simulations do I run to create the chart? It's 100,000. Yes, there it is. It runs 100,000 simulations. We throw out outliers, and the main reason we throw out outliers is they don't add a lot. And what they do add is they may end up adding a result, for example, here on the right, that has a very high profit, that has an extremely low probability of occurring, and that has the unfortunate effect of squeezing the y-axis, so that all the interesting information is squeezed into this very narrow region, so it can just show that one very improbable value off to the right. So that's the main reason we throw out the outliers when we're generating this graph, so we can come up with something that's readable. So that's kind of the main purpose behind the simulation. But there's a couple of cool things you can do when you get into more complex trades. And in particular, when you get into trades with multiple strikes. So let's take a look at a calendar spread. in a calendar spread, in this tool, as in any other tool, it projects the trade outcome to the first strike. After that, you have a very hard problem because the question is, what are you going to do? What's going to happen at the first strike? What are you going to do moving forward? Are you going to end the trade there? Are you going to take assignment? Are you going to settle for cash? Are you going to continue to the second strike, or are you going to just end the trade at that point? That's where we have at least some limited simulation capabilities that will help you understand what that could mean for you. So first of all, you'll notice now we have two available menu items here. The first one is very much like what we've seen already, which is run it out to the first strike. And here's the outcome probability chart for the first strike. It can be a little surprising to realize that that big sharp thing you see in the middle actually is just hidden right here at the profit, at the top of the profit loss curve. But this gives you a better view. Of the probabilities of the trade. So I have a question from Dan, and that is fortunately not for me, I'm glad to see. But getting back to the trade, what do we want to do when we hit that first strike? Do we want to end the trade, or do we want to look at what might happen if we don't end the trade? And here's where the outcome simulation can give you some insights that you're not going to find from the trade risk chart or from traditional tools. What I'm going to do now is I'm going to say, all right, let's simulate this trade, and let's make some assumptions about what we're going to do when we reach the first strike. And you have the ability to specify those options here. We may put in a stop and say we're going to end the trade if the profit loss is above a certain point or below a certain point. If the short call expires in the money, will we accept assignment or will we end the trade? And then finally, if you don't set any of these, the assumption is that you're just going to settle the short position for cash and then you continue on to the second strike. And so I'm going to not check any of these boxes, so we will go with that assumption. And now we have an outcome probability chart that shows what the trade looks like if you actually follow that model. If you get to the first strike, you settle for cash. Here's an outcome probability chart on what happens at the closing, at the final strike for this. So it gives you some flexibility. Again, it's very far from a full, complex, full-featured Monte Carlo simulation of a trade, but it does give you some capabilities to understand a trade like this. I've shown you most of the features except for one. And this one feature I haven't shown you yet is Lookup Option Chain, which used to work. The idea is you would put in a ticker, it would look up the option chain, and it would give you it would give you all the available strikes, the dates, the prices, and so on. And you could pick one, and when you picked it, it would automatically populate a row here when you're setting up the trade. In the original version of the tool, I did this by having the tool look up the data at certain sites like Market. What was it? At Big Charts, look up the tables and scrape the screen, which turned out to be very unreliable because they were changing the layout of the screen on me all the time. And then I discovered the Yahoo capabilities, where Yahoo was running a web service that you could use to look up options chains, and the Yahoo query language, so that if you put in a ticker here, like Yahoo, you could look up the option chain. And this was free, and as is often the case with free data, you get what you pay for, and at some point it stopped working for me. So if we go here and try to make this query to Yahoo, this gives us a look that's happening under the covers, and you can see Yahoo isn't giving us any response. So this ability to look up the option chain is just gone. And as long as I'm relying on free data services, it's really not possible to do that. If I were to hook up with some sort of paid data source, then I'd be able to get that working. But of course, there is no income to me coming from this tool, so I'm not going to be paying for data. And so that capability is not there. That's a quick look at everything this tool does, and I see that some conversation has started about it. Are there any questions for me?
Well, Nathan, I had a question. This is Dan. Good morning again, and thank you
Morning.
for your excellent presentation. I've been using your calculator since I think about 2010, maybe. And I actually
you originally contacted me in 2011, and at the time it was still the Java, the client Java-based tool.
Yes, I remember that well, and I actually remember our correspondence. I asked you if it would be possible for you to put in the standard deviation markers, which you did.
Indeed,
which I think
did,
was,
these purple lines.
So anyway, I really like the information that your calculator affords, and as I said, I used it for developing a strategy. I was a mentor at that time, and I would encourage my students to go to your calculator so that they could see how some of the strategies that are commonly in use really do not generate good expected returns based on probability alone, as of course, obviously you know, and that we maintain our edge as traders by good money management and by making timely adjustments. So once again, thank you for the tool. I did have two questions. The first is the question that I had submitted previously that said to all participants. That simply means that everybody can see the question, but it actually was directed to you. Do you recommend for positive theta, negative vega strategies that many of the people in the community here use, do you recommend maintaining the default 3 standard deviation cutoff, or would you use a more realistic approach and say go down to 2 or 2.5 standard deviations, recognizing that we would probably be out of the trade with a market move greater than 2.5 standard deviations?
You know, I have no opinion about a question like that. I will, let's see, let me bring up the risk chart again. Let me bring up the simulation. So right now, actually, it's not interesting for this trade because this trade has limited upside and downside, so outliers aren't going to matter. Let's pick one where it does matter, like a long call. Okay, so we have an unlimited upside in this trade, and so rejecting the outliers basically means, I mean, it doesn't really mean anything on the left. But what it means on the right, if we allow outliers, there's a possibility of some small number of points here just at the very top. So let's try not rejecting outliers, see if that makes a difference. Okay. What I really need to do is put these two side by side. But what this did is, I think we may have had one outlier here that gave us a higher PL than we saw before. And it shows you a little more, a little more detail at this end, and it has the effect of squeezing this part of the graph. Is that useful? Is that something you're going to find useful to allow those outliers to influence the graph in this way? Because really the question is not so much about how it affects the trade as how it affects the view that is generated of the probability. Right? You know there is unlimited upside or unlimited something, unlimited downside, depending on the trade. Is it going to be helpful for you to see that show up in the simulation, to see that show up in this view?
Yeah, well, actually, that's sort of the crux of the question, because, for example, for a butterfly, either a standard classical butterfly placed at the money, or for some of the butterfly strategies that are employed here in the community, there will be a substantial difference in the calculated mean P&L and the calculated break-even point if you drop the cutoff to, say, 2.5 standard deviations as opposed to the default of 3.
That's true. And, of course, the risk you have in any simulation is these are randomly generated prices. You can run it, especially if you start including the outliers, you can run it a bunch of times and get substantially different results depending on which outlier values are generated. So that's the risk you have when you allow the outliers, and is that going to be helpful or harmful to you in evaluating the suitability of the trade or in making any trading decision during the life of the trade?
Right, okay. And since the results should be interpreted, obviously, in the context of what is the trade likely to do if there are no adjustments, no stops, no exits, no additions, just the pure probability play. That is some useful information, but I don't really, obviously the differences are not that great if you let it run to the default value.
Yeah. Now you were mentioning butterflies as one of the trades of interest. Of course, butterflies have limited upside and downside, so it's not going to make any difference to what I show here, to what this tool shows you, as to whether or not you allow the outliers.
Right, for that, but many of us in the community, actually, Tom and I have a strategy it's called the road trip trade, and Jim has a strategy called the Kevlar trade, and there are several other strategies which actually employ a bearish leaning butterfly. And then the success of the trade often depends on the way the trade is managed, as it evolves. But it's extremely useful to see the pure probability, and so for our road trip trade, for example, there is a fairly substantial difference if the extreme outliers are removed, because since it's a bearish leaning butterfly, the way that we set it up, there is no upside risk or minimal upside risk, which we take care of as the trade evolves. So the entire risk is a downside risk. So depending on whether the trade would be allowed to go to the full 3 standard deviations for the simulation or a smaller number does make a difference.
Okay. Yeah.
And so then my second question may be a little shorter, at least I hope. Do you have any recommendations for using your tool, during the evolution of the life of the trade? So, for example, on our road trip trade, again, I'll just use that one. If we input our starting prices, the starting volatility, and the premiums, then obviously we get the curves which are generated. But that is obviously one moment in time. Do you have any recommendations for using your tools, say, 20 days from now, to see if, to try to determine if we are in a completely different data set, or if we should still abide by the probabilities that were generated in the first simulation? I hope that was a clear question.
I think I understand the question, and I could perhaps contrive something. Let me think about that a moment. If I were in that situation, it's like, okay, 20 days have elapsed, the market has evolved this way, the trade has evolved this way. I think probably the best the tool could do for you is say, all right, let's set up the trade today. Here are our positions. Here are what they are worth, and we need to evaluate. We need to compare what we could get by closing the trade today to what today's probabilities tell us about the outcome. In other words, just treat it as a new trade that starts 20 days from now with some new set of initial conditions. There's nothing, certainly nothing here that attempts to simulate the evolution of a trade.
Well, that was the way that I have been using it. So what I routinely do is to save the URL link so that I can always go back and see the original log normal distribution and the overlay of the payoff curve. And
okay.
then I could.
So,
then
and
I
as you see, that saved URL includes the starting date. So even if you're looking at it 20 days from now, it's showing the trade as you originally set it up.
Right, exactly, and that is a very handy feature for me anyway, because then I can make some assessment of whether or not I'm still in the data set, the same data set, or whether I should be thinking it's really time to close this trade now because all the probability information that I had originally is now no longer valid. Okay.
Well, so it sounds like you're doing essentially what I think would be the logical way to use it.
Yeah, I think so. Yeah. So thank you very much. Those are all the questions that I had. And once again, thank you very much for your tool. It is, certainly greatly appreciated by me, and I have been showing it to other members of the community.
Okay. I see I have a question from Steve Polensky. Are the 100,000 simulations based on drawing from the log normal distribution of expiration stock prices? Yes. I generate 100,000 prices at the expiry, following log normal distribution, using the volatility, and for each one of those results, I calculate what the stock, what the price is, or actually, if the price is what comes out of the simulation, I calculate the profit and loss at that price, and that's how we come up with the data that shows up in the simulation. So I'm just to generate this, I generated 100,000 prices based on the log normal distribution, based on the standard probability model of normally distributed returns, and from those calculated the profit loss and came up with this.
Would there be any way that we could end up ever providing you with a distribution curve?
That you could end up providing? I'm not sure I understand the question.
I one time sat down with the head of derivatives tradings from J.P. Morgan, and his very first question to me is, what distribution method are you using? And when I told him log normal distribution, the conversation was over. Okay. He said that you need to be able to end up providing different distribution models, to be able to end up accurately representing the type of market. So this way, he could end up actually changing the distribution to see how trades would end up performing with a different distribution.
What you would want is to be able to provide some other probability model that you could drop in here, and that would affect both the shape of this curve that appears in the risk chart, and that would be used to drive the generation of prices in the simulation.
Right, and the simplest method of doing that, and I've done this work, is to end up going and finding what the distribution is of whatever underlying you're looking at over whatever period of time you want to take your sample set, and just simply take a look at the actual distribution, roll it into, let's say, 100 different bins, make your own bell curve from the 100 different bins you end up having, because you'll have the probability of the actual data that you want to end up putting in. And it would be, I think, relatively easy in the sense that the only thing we would have to end up providing you is, 2 columns of here's our distribution, okay, and here's our, how we're measuring it. So, for example, one of the things that I had done was that if you take a look at the SPX since the time it was started back in 1950, what you'll end up finding is that you end up having nearly 17,000 instances, meaning trading days. And then you can end up actually doing a distribution of, well, what do those trading days look like? And you'll find that right? The biggest loss that you end up having is around 20.5%, and the biggest gain you have is about 11.5%. So the way most quants will end up building their distribution models is that they'll build those 100 bins and then give the percentage, okay, obviously totaling up to 100, giving the percentage of what's the probability that it goes into that 100 bins. One of the 100 bins, okay, depending on what you have. And what you end up finding is that you have very, very long tails because things like the down 20% day only happened once. And then the next day after that, I forgot what it was. It wasn't, I think the worst day was like 9% or so.
Okay.
And so by being able to provide
cool
that.
Idea. Cool idea. So let me answer that in a couple of ways. First of all, I'll say I'm open to the idea of enhancements. And Tom, since you've talked about being interested in creating a forum for this tool, I think that would be a great place to discuss ideas like that. And I can't make any promises, of course. This is strictly a spare time project for me. But it's a project I find really interesting, and I'm certainly open to the idea of enhancements, including doing something like that. As I think about implementation, one place you would want to see that reflected is the probability curve here. Of course, this is no longer going to be a log normal distribution. This is going to be some custom distribution that would be based on the data you provide. And the simulation gets a bit more complicated, and it actually would get a lot slower. The form already exists. Great. And the reason it would get slower is right now when I run this simulation, there is a certain shortcut I'm able to take. And that shortcut is that it turns out for this particular probability distribution, that is for the normally distributed returns assumption that we're using here and that underlies the Black-Scholes model, it turns out that it's very easy to generate the ending prices. You can take the starting price, you can apply a random return based on the volatility for that period, annual volatility if it's a year, monthly volatility if it's a month, whatever. And in one calculation, you can calculate an ending price, and you will end up with the same distribution results as if you had done it in smaller quanta, as if you had, say, taken the daily volatility and done day-to-day calculations. So that works because this particular probability model is really tractable that way. You will get the same end distribution of prices at the expiry, whether you apply one calculation using the volatility for that period or daily calculations using the daily volatility. Once we go to some other probability model, that's no longer true, and so we're going to have to start simulating the daily changes. So that would make this simulation quite a bit more expensive and slow to run. Whether that would be worth it, I don't know. What I can tell you about Google App platform, the platform I'm running on right now, is I've put my tool there, and it's not costing me a dime because it's just not using a lot of resources right now. There aren't a ton of people using this tool, and so the services I'm getting from Google are free. If we got to the point where a lot of people were using this tool and or we did something that greatly increased the calculation cost, then I would run into a situation where the services I'm getting from Google are no longer free, and so then there might be we might have to figure something else out about how to pay for those capabilities.
This is Jim Riggio, right? Tom and I were the founders of a Capital Discussions, and Dan had, is kind of a co-founder and helped us from the very beginning. We'd be very glad to take that conversation offline because when it comes to being able to end up doing that, if there was a cost, we could end up actually help marketing it. If it became extremely useful to our subscribers, I'm sure that they would end up contributing to end up helping to defray the cost of not only the development but also the running of it. So we can end up having the cost conversation offline. But thank you for your answer.
Okay, great.
And Dan, I know you've used the tool for quite a while. Are there any other enhancements that you said, oh, I wish it could do this or that? Well,
actually, not at the moment. one thing, I'm not sure whether Nathan pointed out, maybe he did because I had to walk away from my desk for just a second, but and that is that you don't necessarily have to take the payoff curve to expiration, and in fact, I routinely don't.
Oh yes, I showed this feature. You're talking about the computing the results before expiry.
Yeah, sorry, I guess I missed that. But of course, that will give entirely different. That will give entirely different numbers when the simulation is run, but is actually, for most of us in the community, is much more valid. Most of us tend not to take things that we trade here to expiration, so that's a very useful feature. But I don't really have any. I think that the tool is so well designed as it is. I really don't really have any suggestions for any other additional enhancements except what Jim mentioned, which I think would be extremely useful.
And we could even possibly have the conversation of having like an enhanced version that pulls in live data that's paid data, and then we would have to create a subscription for that. But that's again another conversation, but something that's definitely possible.
Sure.
All right. So thanks very much, Nathan. Any last points before we wrap it up?
No, I'm just actually thrilled that this has been discovered and it's being used, and people are finding it interesting and of use. And I consider what it does interesting, and that's one of the reasons that I'm definitely willing to keep up the conversation and talk about where we can take it.
Nathan, I really look forward to continuing that conversation, because I think that with just the slight modifications that we talk about, the tool becomes incredibly helpful, in real-world trading, and not just, the theoretical beginning that we always, people like Dan always use it to end up saying, theoretically, do I have an edge to begin with? So thank you. Thank you so much for coming and presenting to our community. We truly appreciate your time.
My pleasure.
Okay, thanks, everyone.
Okay.
Thank you, Nathan.